Over the past few months, something unusual has been happening in public markets. Many SaaS stocks have dropped sharply. Not only early-stage names, not only unprofitable bets, but established software companies that investors treated as premium assets for years. At first glance, people blame the usual factors: macro uncertainty, cautious spending, higher rates. Those forces matter. But there is a deeper shift under the surface. Artificial intelligence is changing how software is built, how fast competitors appear, and how investors think about what software companies are actually worth. For almost 15 years, SaaS looked like one of the cleanest models in tech investing. The logic was straightforward: recurring subscriptions, predictable renewals, high gross margins, and expansion revenue from existing customers. Markets rewarded the consistency with high revenue multiples. Growth itself became the core valuation driver. As long as revenue growth remained strong, investors could justify premium pricing even when profits were still in the future. But that entire valuation framework rested on a mostly unspoken assumption: building and improving enterprise software required large teams, long cycles, and significant capital. That assumption is weakening fast. AI coding tools are now reshaping the production economics of software. Teams can generate boilerplate instantly, prototype products in days instead of months, automate documentation, and accelerate testing and release cycles. This does not mean software becomes trivial. It means the cost and time required to reach good enough in many categories is falling. That has strategic consequences. If a smaller team can ship competitive functionality with AI leverage, incumbents lose part of the scale advantage they once had. New entrants can test ideas faster, iterate faster, and attack narrow vertical niches that used to require much more capital. So investors are asking a hard question: if software production is cheaper and faster, how defensible is a SaaS moat that depends mostly on feature depth? Equity markets are forward pricing systems. They do not wait for the full effect to appear in quarterly results. They re-rate when probability distributions change. SaaS multiples were historically high because future growth looked durable and relatively predictable. Now, expected outcomes are wider. Investors see more downside scenarios: faster commoditization, AI-native competition, weaker pricing power, and lower switching friction for customers. When uncertainty increases around future growth quality, valuation multiples compress even if current revenue still looks healthy. That is why a declining SaaS stock does not automatically mean the company is broken. Often it means expectations have changed faster than current fundamentals. AI disruption is only part of the story. The other major force is capital cost. In the low-rate era, distant future profits were discounted lightly. Growth-heavy business models were rewarded, and many SaaS companies optimized for expansion over near-term earnings. That made sense in that regime: hire aggressively, spend heavily on sales and marketing, and capture category share first. When rates rise, the math changes. Far future cash flows are worth less in present terms, and investors demand clearer paths to profitability. So many companies are now moving from growth at all costs to efficient growth and free cash flow discipline. That transition is strategically necessary, but it can produce valuation pressure during the adjustment period. There is a deeper business model shift underway. Traditional SaaS primarily sells software access. AI-native offerings increasingly sell outcomes. Customers are starting to ask for solved problems rather than more dashboards, automated support resolution instead of ticketing workflow, generated analysis instead of manual reporting, finished output instead of tool complexity. When that happens, value capture can move away from seat licenses and toward performance, throughput, or measurable business impact. In practical terms, software increasingly behaves like an intelligence layer rather than a static toolset. That threatens parts of the classic SaaS pricing and packaging model. SaaS is not disappearing. It is evolving. The likely winners are companies that integrate AI deeply into customer workflows, reduce user effort, and convert features into business outcomes. That usually means fewer clicks, more automation, tighter data loops, and pricing structures tied to realized value. The center of gravity may shift from software as a service to intelligence as a service. In that world, having a product is not enough. The product must continuously deliver compounding customer leverage. Companies that adapt early can expand their moats. Companies that rely on legacy assumptions may see steady valuation erosion even if their products still function well. The recent drop in SaaS stocks is not a single cause event. AI is reducing software production costs and accelerating competitive pressure. Higher interest rates are tightening valuation frameworks and raising the bar for profitability. And customers are moving from paying for tools to paying for outcomes. What we are seeing is not the end of software. It is a repricing of how software businesses create and defend value in the AI era.